So guys, I'm going to be showing you why in this video you should not be using indicators in 2025. Right? The reason being is because indicators react to price action, right? So it goes off of what price just previously did. Now, the thing is, what if volume didn't step in yet? What if the big money didn't actually take positions? They could easily wipe out that moving average trend, right? They could easily wipe out the MACD cross or whatever and completely flip the direction. And that's pretty much what it comes down to. When you're using indicators like an RSI, a MACD, or moving average, or anything out there really, you're not getting any context of what's actually happening in the market. All you're seeing is what price previously did. So what I want to walk you through in this video is the thing I use instead of indicators. And I promise you guys, this strategy is 10 times better. Ever since I started using this, my win rate has been well over 80%. Pretty much trading just a blank chart. So that being said, I'm going to dive straight into this, show you guys real examples, real trades, and I promise you, you're going to get a ton of value from this video. Let's dive straight into it. All right, guys, so I'm on a blank chart of NASDAQ, and looking at this chart, we have no indicators on here, and you might be looking at this chart pretty lost. Well, I'm going to be showing you in this video how to not feel lost when you're looking at these blank charts with no indicators. Now, the thing you really want to look at is these three things. The first thing is key levels, second thing is market structure, and the third thing is volume. I'm sure you guys have heard of this stuff before, and you even use key levels, market structure, and volume in your trading as well, and they can be super helpful. Now, the only issue is how do you get your key levels right now? And I guarantee you most of you are saying that you look at maybe yesterday's lows, yesterday's highs, London session lows, London session highs. You look at 4-hour supply and demand zones, right? 1 day supply and demand zones, 1 hour supply and demand zones, right? Whatever that is for you. Now, the problem is if I find a key level from yesterday's lows, for example, the issue is you're still reacting off of previous price action. Sure, this can be a great support level, and this has turned out like from this low last week. This has turned out to be a great support, right? We bounced off it like 3 different times. But again, what we're still doing is we don't have a real context of the market. We're still pretty much just reacting off of previous price action, just like an indicator does. Now, what about market structure, right? You can look for higher lows, higher highs, higher lows, higher highs, right? But what happens when we stall out, right? And we start consolidating, and let's say, you wait for some higher lows, higher highs, higher lows, higher highs, and then you get in on this higher low right here, for example, today, right? And then boom, we just start consolidating and doing nothing, right? Now you're stuck in this trade. You might get stopped out. Maybe you put your stop to break even. You have no trade for the day. Well, if there's no more buyers? So again, you're kind of left without any context of the market. Okay, volume. What about volume? Okay, volume is a very helpful tool because it shows where those key levels actually matter. The reason people use volume is to read the difference between buyers and sellers. Okay, where is that big money stepping in? You want to trade with the big money, the institutions, right? Where are they actually stepping in? But the only issue is sometimes volume will just randomly be exaggerated and then nothing will happen from it. For example, we have super big volume here, right? We have kind of like a doji candle, but nothing really came from it. After that, we kind of just consolidated and did nothing for the next 2 hours, right? So again, it doesn't give you the full context. So what I started doing instead is I started reading the market structure of the institutions, right? The institutional positioning in the options market, right? And the way to read the institutional market structure is looking at the Greeks in the options market, okay? Keep in mind, I trade NASDAQ futures, but I get all my levels for the NASDAQ on QQQ, which is the mirror of QQQ, right? The regular stock. And the reason why this is important is because options is what actually moves the market. The majority of market volume comes from the options market. It's not from NASDAQ futures, right? There's only like 20% of the volume comes from NASDAQ futures. So options is what truly moves the market. And what we're able to see in the Greeks, right, is we're able to see where institutions and market makers have to hedge their positions to stay delta neutral in the market. You're going to be able to see where price will consolidate, where price will accelerate, where price will be defended, where we're going to reverse, right? It gives you the behind the scenes of the market. And honestly, just looking at a chart, I don't know how people trade with just a chart. It makes sense why so many people fail at trading because, again, you don't get any context. It's like trying to drive to New York 60 years ago from California, right? You just have a paper map and you're looking and, you don't know what's going to happen. You don't know exactly the best route to take, right? When you're trading with the Greeks in the options market, you get Siri telling you where to go. Now, the question is where do you actually read this data, right? Because this data is pretty much hidden from retail, but I promise you every institution, every hedge fund reads this data, right? And they actually spend millions of dollars a year calculating this data, hiring engineers to calculate this data to see where they must hedge their positions to stay delta neutral in the market, right? Because think about it. If these big institutions are providing liquidity to people who are buying, right? They're buying. This means these liquidity providers, these institutions, right? They have to sell those contracts to people who are buying. Now, what happens when they sell those contracts is they're going to be kind of short on the market, right? So they don't want to be short on the market because they just want to provide liquidity. They're not trying to make money from trading, right? They're just providing liquidity. They're making money off fees and spreads, okay? Now, what happens so they can stay neutral in the market is they have to hedge their position by buying futures, right? So they will actually hedge their position inside the futures market, right? And we're able to read exactly the structure, where they have to hedge their positions, where there's going to be more pressure for them to buy or sell, and all that good stuff. So I personally use a software called MaretkFlow. This is actually my software I came out with. It's called MaretkFlow. And like I said, it's going to provide you this data, right? It's going to show you where market makers must hedge their position. So for example, right, we can look at today, okay? We have a replay mode, so you can backtest this, and you can see this real-time data coming in, okay? So for example, right, and this is a little bit different from charts, so just hang with me there, but I promise you, it's very simple and it'll blow your mind. Okay, so if we go to October 20th, for example, this is today as I'm making this video. As we can see, if you just focus on this top row right here, okay, ignore the bottom row, that's something a little bit different. So just look at this top row right here. And as you can see, when the market opened at 9:31 Eastern time, we can see that there's overall a lot of buyers in the market. We have institutional flow, and we also have delta hedging. These are the main things you want to pay attention to. And then we also have time to pressure, which is basically options decay, right? So they have more incentive to bring it to the tallest bar because they're going to make more money. But besides that, anyways, if we look at this, we can see there's pretty much an imbalance of buyers, right? Can we see that? We pretty much have all positive and very little negative. Okay, so this alone is giving you way more context of the market over this chart. Can we agree? When market open right here, right, we're going to do the same thing. 7:30 my time, so that's 9:30 Eastern, right when the market open. Do we know that there's more buyers than sellers? Do we know that there's a huge imbalance of buyers versus sellers? Based on this chart, I don't know. It looks pretty balanced. Like pre-market kind of just chopped around. Maybe there's slightly more buyers, right? The trend is up for sure. But it doesn't give me much context, right? But we can see this is giving us a lot of context. Almost all buyers, and we can see the exact levels. Now, if you're wondering, well, Chad, these are QQ prices, not NQ. So you could just actually download a price converter. It's a free indicator. So I guess I do use an indicator. This is one of them, but it's called QQQ. And it's this one right here by PT Gambler, QQ Index NQ Price Converter. Just put that on your chart. And it's going to show you the levels. So for example, I just changed this to per candle close and then take this out. Okay, and now we have all the QQQ levels on our NASDAQ chart. So each level in QQQ is around 40 points on NASDAQ. Okay, so now we have all the levels on here and now we can read this a lot better. So now that we know that there's a lot more buyers than sellers, we don't really need to look at the market structure on the chart. We can get rid of that, right? We have it right here. Okay, now the next thing we want to do is we want to find the key levels, and the way we do that is through the delta hedging. Okay, so this is going to be very important. Now, what we can see is we see a peak right here. This green bar, this is at 610. Okay, so this highest interest bar basically means that this is the target for the day, right? The most pressure is on this bar. When we get to 610, what that means is the institutions are going to be neutral in the market. This is where they want to bring the price action, right? Because they're not going to be, flipped upside down on all the liquidity they're providing. They're going to be neutral in the market. And basically what this is telling us is they have to buy they have to keep buying until price goes to 610. So they're going to push the price to 610. And now the other thing we can see is this level right here, right? You notice price pretty much drops off right after that, and we have no interest below. So this level will hold. Okay, there's a very high chance that this level holds, and they're going to want this to hold, right? So 607. Now, as you can see, when we opened up, we actually pulled back directly to 607, right? So you can see that, but let me just go to a 1 minute chart. And you can see we open up, we pull directly back to that 607 because, again, this is telling us that there's no interest below 607 right here where my mouse is. Okay, it pretty much completely dies off. So that is a level that has a very high chance of holding. Now, this could be a place where you enter. As you can see, it pretty much just freaking ripped up in 1 minute. Ripped up nearly 80 points on the NASDAQ. So you pretty much would have been done the first minute of the day. Again, if you had context of the market. Now, like I said, we have room to all the way to 610. Now, let's say you missed this trade because I'll be honest, today I actually missed this move. I did not take this trade. I actually waited until we broke this 609 because, again, this thing just moved so fast the first few minutes of the market open. So 609 is this level right here. And like I said, the reason why I traded from 609 to 610 today, right, because this is the target for the day, this biggest green bar. So if we go forward a few minutes, we can kind of see they kind of switch around the first few minutes, but now it's holding 609. We have increasing interest to 610, which is the target. And now look what happens, right? After 609, we pretty much have no interest below, which means 609 should hold, right? Making it a very good area to put your stop loss under this level. Okay, and we can get to the 610 level. And maybe if we break 610, we can get to 611, 612, and the maximum for the day will be 615, right? So this shows you the positioning of the institutions. Okay, and our job is to find, areas where we can trade it. So for me today, that was, as soon as we close above 609, I got long right here. I put my stop below this candle and we rode it up from there. It did chop around a bit, but again, this level was not going to break, right? It's going to act like it'll break, just depending on how choppy the price action is. But based on the Greeks, the positioning, which I trust, this level will not break. Okay, because there's no interest below this thing. All right, so that was today's example. Now let's go back to another day. Okay, so we're just gonna go day by day. Again, I don't cherry pick days. We're just showing you the structure of the market each day. Let's go back to Friday, October 17th. And to make this easier, I'm just gonna switch over to QQQ. But like I said, I do trade NASDAQ. That's the only thing I trade. But to make this a lot easier, we're just going to go to QQQ so we don't have to convert all the levels. So I'm just going to hide this for now. And let's go back to Friday. We're going to go to 10/17, October 17th, right when market open. Let's see what it looked like. All right, what do we notice about the structure of the market? Pretty much all the interest is on 600. And then we have some defense bars at 597. 595, and then some big interest at 590. This doesn't matter as much because we're so far away from it. So let's go forward because this can change a little bit. As you can see, what happens, 597 looks like it's going to be the defensive level, right? So another thing with these Greeks, right, and this is really the only other thing you need to know, is when we go negative, the market makers are always going to try to defend that level, right? They don't like the market going negative because they basically have to flip all their hedges and completely just flip it, right? So they go from being long on everything to short on everything because we're going in that negative territory, because now they're going to have to start selling, right? Because if a bunch of people are selling, right, and they're providing liquidity to people who are selling contracts, right, they have to buy those contracts from people, then they have to re-hedge and sell more, right? So they can stay neutral from the contracts that they're buying from people, right? So they completely have to flip everything. So this is where the market structure flips, right? And this is a really easy way to see where market structure will flip. So basically on this, if we break 597, which is that first basically negative bar, the first one's 598, but this one's a little bit taller, so it should act as, more of a support. Basically what happens is the trend flips, we turn short, and again, it's the same thing with market structure. right? Instead of looking at, higher lows, higher highs and seeing if that structure flips. Again, what we're doing is we're reading the institutional market structure, right? Where does the trend actually flip for the institutions? So for me personally, I only want to trade with the big money. I want to copy what the big money is doing. I promise you, you're going to trade a lot better if you do that. Looking at the chart doesn't give you enough context, okay? Because every time frame is different. You can look at a 5-minute time frame and be like, oh, we didn't break the low on that one, but on the 1 minute we broke the low. Oh, we broke a low on the 5-minute, but the 15-minute we didn't. Right? Everything's different. There's no time frame. It's all the same. There's no time frame. So we can see exactly where market structure will flip. Okay, so for me, 597 is a buy, right? I want to get long here because that is where institutions will defend price action. Okay, they're going to try to defend this level and bring it up to this target 600 because that's where they're going to be delta neutral. This is where they want to be. So for example, we get all this information the first 2 minutes of market open. Okay, we don't have to wait for a higher low, higher high. We get all this information within 2 minutes of the market opening. As you can see, what happens, it is right here. Where's market open? Actually opens back here. Okay, so let's mark out 597. Okay, that's that bar we're on right now, this negative bar. Okay, as you can see, market opens right here at 7:30 my time, 9:30 Eastern. What happens? Right, we take the level to a T and we bounce straight up to 600. I mean, guys, it's that simple. We literally go straight to 600. And this is the trade I took this day. We were done within 10 minutes of the market opening. As you can see, I basically, I usually like to wait for a green candle. So I waited for this green candle, put my stop on the lows and simply rode it up to 600. Not a huge risk reward, but we were done for the day as a high probability trade. Then again, as you can see, we retested 597 again. This thing is going to be defended once again because they don't want to go negative. We can get long again, put our stop on the lows, ride it back to 600, right? It's really as simple as that. Again, we're able to get all this information within the first 2 minutes of the market opening, right? You're reading the market structure of the institutions. Stop reading market structure of the charts, right? Because if you're doing this, for one, you're going to miss this trade. You have no idea what's going on when the market first opens if you're just looking at charts. For two, let's say you're like, okay, I'm waiting for a higher low. Okay, here's a higher low. All right, this trade would have worked. You would have got a winner here. Okay, let's take another trade. We got a higher low here. Oh, we get stopped out. We go back down. Oh, we start chopping around, right? Oh, we pull back to this level. We're going to break down. Nope, we're defending 597 again, and it rips straight off of it, right? So you could have taken 3 huge trades off of that level. Again, just reading at the market structure of the institutions. We can actually go to my Discord. You can see this is the trade I took. Okay, I'm not just saying this. We can go to 1017. Okay, went long on NQ this morning at 9:31 Eastern time. So let's do one more example just to show you guys how well this works. Like I said, we're not cherry picking days. I'm just going day by day. So we're going to go to Thursday. This should be the 16th. Let's go to the 16th here. And we're going to go to the first minute. As you can see, we pretty much have some increasing interest from 605 to 606. So this could work. As you can see, after 606, it decreases to 610. So I personally don't want to buy. I like to see the bars increase steadily, and that's going to make me buy. Okay, if I see it decreasing, even though there's a big target here, I'm not as confident in it, right? It tells me there's a lot of buyers at 610, right? And market makers want to get there, so they stay neutral in the market. But there's not a lot of buyers on 607, 608, or 609. So it's going to be really tough to get there unless something changes. What this is telling me is we have a lot of buyers at 605 and we have more buyers at 606. So we should accelerate straight to 606 if we close above 605. So if we look at market open, we can see where is 605. Okay, 605 is right here. So in this case, we actually opened above 605. So in this case, okay, this is kind of weird because we opened above 605. So in this case, pretty much by the first minute, the trade already happened. So I actually didn't take this trade. So we can go forward. As you can see, we end up pulling back to 605 again. So let's go forward like 10 minutes here, because it'll change a little bit the first 10 minutes as the new orders are coming in. All right, so now we can see 941. Okay, this is the info we have. 605 should hold. Okay, we pretty much have negative interest after this, so 605 should hold. Then we have increasing interest from 606. We have good amount of buyers on 606 and more buyers on 607. Pretty decent buyers on 608, and then it drops off, right? So in this case, now I want to look to either get long at 605, get long when we break above 606, and then trade that either to 607, at least trim my position, maybe hold the 608, but like I said, the highest probability is going to be that 607 level, right? This is the highest bar before it decreases again. So anyways, as we can see, let's mark out 606 right here. As you can see, as soon as we break it, we pretty much just rip straight up to this 607, right? And that was my trade for the day. So I actually took the 606 breakout straight to 607, and I actually had my stop on here. Okay, so I could put my stop right below that break candle. Okay, as you can see, it retested it. And boom, we got our move straight up to 607 within 1 minute. And this looks like a very small trade, but on NASDAQ, right, this is like 35 points. That's a good trade. Each level on QQQ is 40 points on the NASDAQ. So as you can see, we went straight to 607, pulled back again. We kept holding the 605, kept holding the 605. So these could have all been pretty good trades. You could have got off that 605 level. So anyways, guys, it's all about reading this market structure. This gives you the behind the scenes of the market, what's actually going on, right? This is going to give you the true market structure. There's no time frames where it looks good on a 5-minute time frame. Oh, it looks bad on a 15-minute time frame. Oh, but it looks good on a 30-minute time frame, right? That form of trading does not work. So that's my first issue with charts. The different time frames. The second issue is the indicators, right? If you guys are using any sort of indicators, again, all indicators do is it's a calculation based on previous price action. Now, that can be helpful sometimes, but if you have no context of what the price needs to do at certain levels, right? When we break 606 and we are showing more buyers on 607, we know we're going to break out of that. Right? So you don't need to wait for a pullback. What happens if we just rip straight up? And sometimes we do, and we actually did this day. If you waited for, a higher low or whatever, when we broke 606, you wouldn't have missed the trade, right? But as you can see, I didn't wait because I knew price would accelerate. We have more buyers on 607. Price needs to push there, and boom, we just ripped straight up, right? And I'm out of my trade within 60 seconds. So anyways, this is what I've been using. Is the actual institutional market structure. This is what really moves the market on a day-to-day basis, because again, this is showing where the big money is going to be buying or selling, and they control 70 to 80% of the market volume. So anyways, guys, if you want access to this software that will show you where price actually is going to go, gives you way more context of the actual market. Like I said, this is what I use to trade every day. This strategy works 10 times better than any other indicators. If you guys want to sign up to it, we do have some cool bonuses with it. Like I said, MaretkFlow is my software, and inside of here, we actually work with you, right? So we don't just give you tools and data. You'll be able to trade with us every day. So you get access to the MaretkFlow platform. You'll be able to trade live with me every single day on our Zoom calls. We also do daily mentorship calls. So these are optional calls where we all hop on Zoom together and we go over any questions, the trades we took today, all that good stuff. We also have a private community and training where we go kind of over the stuff more in depth on how all of these tools work. So anyways, guys, if you guys want access, all you have to do is go over to otsflow.co. I just launched this platform and we already have tons of members getting really good results with this and saying it's changing their lives, changing their trading forever. So I guarantee you, after you start using this, you'll never go back to a blank chart. So anyways, guys, hope you found some value out of this video, but this is what actually moves the market, is these flows, the institutional positioning, not the stupid little trading view indicator. So anyways, guys, hope you have a good one, and I'll see you in my next video.